Martin here from CORRECTION. Welcome to Markets Next Week, the weekly stock market analysis, where we look at technical charts and try to understand what happened in the market over the previous week, and then also plan for a bit of trading week for the upcoming week that's starting from November 4th, Monday, 2024, tomorrow. So lots of things to look at. Let's deep dive into the charts first. So here's the weekly charts, which gives you an understanding that the price has been steadily rallying without any major corrections, and then now a correction of 8.5% has come in, and now it has taken a pause last week after a steep correction of 3-4 weeks. Right side you see the Nifty 50's short-term charts, the daily charts. You see a head and shoulder breakdown is happening, and then market seems to be consolidating and at a very close to the very major swing low support. Similarly, on the Banknifty, you see a ascending wedge which hit the top of that wedge almost at the end of the narrowing wedge, and then seems to be consolidating and not ready to easily break down that ascending wedge yet. It's a weekly. Banknifty's daily charts are showing it's a parallel channel, and it has not retested the previous swing lows that it had made a month before, and there seems to be an attempt to recover from the correction that is almost 9%. So that's the weekly charts what it shows. So overall, what happened was a pause after 4 weeks of fall, and it's a 0.5% bounce up. Don't know whether it's a dead cat bounce or not, but it's an inside bar for sure, which indicates consolidation after a steep correction. 0.53% of pause, 129 points. Remember, it's only 8.5% of correction after a 72% of rally from the previous major swing lows at July or June 2022. So the Banknifty also attempted a bounce up today. If you see the weekly charts, and it is close nearly 2% up, 898 points up, and 1.77% up, and it's still below the 50 exponential moving average. While Banknifty is still below the 100 exponential moving average. And remember, the correction is 8.5%, as I said. Right. The recent corrections that it was going on, so the bounce happened from that 3.5% to the Banknifty also. Look at the candlesticks and see after 4 weeks of deep corrections, this candle is an inside bar and a small body in decisive consolidation. Right side Banknifty weekly charts is inside bar, inverted hammer, almost. Inside bar indicates consolidation. Inverted hammer could be a position reversal from that small correction. Could be. Only if the highs or lows are breached, can we get a confirmation of that. Daily charts indicated November 1st, Dhanteras. The special occasion 1 hour trading, that's this candle, so you can probably ignore that because the volumes will be less, but otherwise it's a consolidation that you can see with an indecisive calls close on the Saturday from Friday, special trading day. And also indecisive consolidation is what you clearly see. So if you look at the 4 days, the 4 or 5 days of trading that has happened, it's done nothing but moving up and down while in consolidation. And also moving up and down while in consolidation is what has happened in the 4 days. Net effect is a small bounce up as has happened in the case of Banknifty, better one. Bulge bands, if you see the daily charts, you can see that Nifty had gone to consolidation, but once again it has expanded, which indicates bearish bias, which indicates that we can further fall down. Remember, it is below the 120, 50 and all that exponential moving average. All that is left now is 200 exponential moving average, which is way far down to 23,400. But Nifty, otherwise it's consolidating clearly, no bearish bias. It's about 20, it's about the median of the bullish band. So bullish bias consolidation in the Nifty, bearish bias expansion on the Nifty. So that's totally contradictory. Dices are moving in a in a divergent way. And that's about the price, candles and all that. Candlesticks, a small indecisive candle and inverted hammer like we had seen, and indecisive candles on mostly inside bar. Consolidation bounce up after a big fall is what we see there. So consolidation, volatile consolidation, and indices. This is the nutshell of the candlesticks. So, resistances are very close by. Supports are also very close by, which to retest the previous swing lows. Resistances of moving average there upside. So, on demands we already explained what it is. It's showing contradicting view. Let's look at the momentum using the RSI and the trend using the DMI, and we'll try to understand that on the multiple time frames. Left side you have weekly, right side you have the bank. So right side you have the daily. So you see that the momentum is sideways and rising up in the case of Nifty and Banknifty both. Now the trouble is in Nifty on the short term, it's still bearish, and it's right below the resistance zone of momentum of RSI 40. So that's bearish. Nifty on the other hand has not slipped in the bear zones after the previous swing lows are made, and it's climbing up the momentum up. So the momentum is better in Banknifty in the case of short. So short term, Banknifty is doing good. Nifty is back behind. But last week, its momentum has picked up slightly. You can see, but trend, nothing has happened. Trend, the ADX remains the DMI negative zones on both time frames and both indices. So improvement of momentum is seen, but that improvement does not take the Nifty back to sideways, while Banknifty is just taken back to that sideways momentum from the bear zones, and trend remains negative. That's the crux of what we can understand from the momentum of the trend indicators. Now, with respect to the volatility, the India VIX indicator has 12% or more up last week, and now it's another 9% up, and it's at 15.9. It's very close to the medium volatility. It's no longer low volatility regime. So we are into high volatility regime. We have to be extremely cautious. The reason why the VIX is moving up is very much evident because we have a very eventful week of the US elections and federal decisions and much more election outcomes in India, and all that is coming out next week. So we have to be cautious. So VIX is shouting at us that the fear and greed is there in the market participants. Now, if you look at open interest analysis from the futures, you see there is a contradiction again, similar to the price momentum, and here also we see the open interest. Also we see that Friday special session, then today's special session showing a short covering build-up, and I guess Nifty and it's a short build-up. It's negative bearish build-up on the futures open interest. But for the weekly expiry, that's on November 6th and 7th on the Banknifty and Nifty respectively, has got a PCR of 0.83, which is better than Banknifty, and 0.65 in the case of Banknifty. So both are bearish in nature. The PCR put call ratio for the options for the weekly expiry of number 6-7 are bearish for both indices, and that's that's something that keep in mind. And below the charts are clearly indicating where the highest put and call writing is seen for the weekly expiry. Right, that's one way of understanding where resistances and supports could probably come in, and we still have a few more days left for the expiry, so things could change next week, but as of now that's what it shows. So the highest put writing is seen at 24,300, and 24,800 is where the highest call writing is seen resistance. Second highest is at 24,200, and 24,300 where the second highest call writing is seen. Nifty 51,500 and 52,000 is where the highest put and call writing is seen, and second highest put and call writing is at 51,000 and 52,500. So that's a narrow range that we see for the options writers for the next week. Now, another way of understanding the support and resistance levels is by understanding these charts. Basically, we have the resistances at the moving averages of 100, 50 and 20. Then previous resistance zones are there, then Fibonacci's resistance are there, gap resistance are there. So that's how we identify resistance and supports. Previous swing lows are taken as supports, and Fibonacci levels also is taken for support levels. So the first resistance, of course, would be the 20, 50 and 100 resistances, and then you have the gap resistance at 25, 7, 40. Downside for support with the previous swing lows at 24, 300, and then Fibonacci 50 levels at 23, 7. 40, and then 200 exponential moving average comes in at 23,400, and then Fibonacci 61 support comes in at 23,154. The other rounding numbers at 24,000 and 23,000 that also could act as supports. And Banknifty similarly, the first resistance with a gap at 52,800 nearby, and then 53,000 rounding number, and 53,360 and 53,750, and then likewise resistance in upside downside. For support will be the 100 exponential moving average support at 51,166, and then the swing lows could act as support at 51,200 nearby zones, and then if 50,000 is breached, you have the 49,580 where the 200 exponential moving average comes. Take all of these levels from this, right? Correlate these levels with that what is the potential resistance support levels given by the open interest, and then reach a zone and then place your bets accordingly if you are in the game. Right, that's around more resistance supports. Now let's see how the different sectoral indices performed last week. It's all red. It continues to be red. So we have long pulls on sectoral indices only if both time frames of the weekly and the daily shows bullishness with respect to the momentum. That's not seen as of now. So what has fallen to the bear zones is the IT sector in the short term, and autos and pharma sector also. No, FMCG sector also has fallen to bear zones on the short term, and auto sector also on the short term. So auto, IT and FMCG has fallen to short term bearishness and not recovered into at least sideways. No, it has not done that. Overall momentum is sideways if you take both time frames on almost all of the sectors. That's what I see here. IT sector had slipped down, so that has slid down 4%. There is a defensive stock that is holding the market up. And metal also fell down drastically, 4% down. So IT in the sector and reality were the sectors that got hit last week, right? And others were kind of flattish, except for the FMCG, which lost 1%. So the only sector that was up was pharma, which is 1% up. Yeah, even FMCG also was up. Oh, sorry. And some corrections. Ignore that, please. I'm sorry. IT sector did bad, but reality did good. Good in the sense these sectors had gone down big time and had bounced up. Reality also did good, actually. It's positive 3 plus. So after the big fall, the bounce happened there as well. So let me brief it. Kindly ignore what I said a few minutes before on the sectoral section. So what got hit badly was only the IT sector last week. Recovery was seen in the metal and reality and FMCG and pharma. Right? Because recovery was on the metal and the reality, which moved more than 3.5%. What went flat is the auto. So auto, FMCG and IT is in bear zone for short term. Nutshell. These are the charts for that. You can understand. IT slipped in the medium term sideways momentum. Again, slipping down is what you see here on the metal. Medium term momentum. Auto is in the correction path, already slipped in the sideways. Pharma is holding on and taking support with the RSI 60, still in the bull zones. Pharma is always active, probably it's in the bull zones as of now in the medium term. Because FMCG also has slipped sideways. Reality also is in the sideways. So pharma is a defensive sector, and along with IT was holding the market, but no, pharma is falling to the pharma is the only sector now since IT has fallen down. So forward and let's understand how the heavyweight stocks. So HDFC Bank is doing good as of now. Just climbed back to gain the momentum, and then momentum and trend looks fine. But the problem is it's at a famous great resistance zone where it got rejected multiple times. So once again, it's attempted to make a move above the 1,800 level. So it's managed to do that. The volumes are still had to climb above the moving average. So when managed to climb above the 1,800, then there could be big Banknifty moves, and obviously the market also will bounce back. Now Banknifty could give out all the gains if there is a resistance that it makes it, and that makes a major correction from here. So be cautious about that, and watch out for this HDFC Bank in the coming weeks. Lens is in the correction mode, and the momentum is slipped the sideways on the medium term and slipped to the bear zones in the medium term as well. So it's the most bearish heavyweight stocks, you can say. And it's a very good support zone at right now, and there is a bonus split of the stock has also happened. So there is a possibility it can find a support here. If it doesn't find a support here, it can fall back to 3,100. Now, easy Bank is strong, but the candle is inverted hammer low that is formed. It's in the bull zones. That's the only heavyweight apart from the HDFC Bank, which is in the bull zones. So that is away about 60. Now, right is always hit badly. It's in momentum sideways from Nifty and TCS, and CORRECTION as usual it's in the sideways always. ITC is showing some bullishness. It has slipped to the sideways, but it's a couple handle. It is attempting to move once again back from sideways. So what's holding the market is this HDFC and ICICI Bank, and what's troubling the market is the Reliance, which is immediate dip correction, and IT is not supporting, and then CORRECTION is showing nothing. That's a summary of how the heavyweights that contribute maximum to indices are performing. Let's look at the broader market indices of mid cap and small cap. You can see that there is a 10% correction that has happened in both indices, but look at how the solid bullish candle is formed and market has bounced back, and this is in the sideways, but that is a good bounce. We'll have to see whether it sustains or not. As of now, it's in correction mode, you can see the broader market indices of mid cap and small cap. Let's try to understand how the institutions have done last week. They are selling for in Diamond last month for 1 lakh crores, and now again selling 14,416 crores of selling. Domestic institutions have been buying forever. 10% crores of buying has happened. And long-term derivatives have moved down always. Look at 5 days of selling. The entire October the price was selling. Their money is holding the market. That's unfortunate, but and it's not unfortunate that they is holding the market. It's unfortunate that the FIs are not putting in the money into our markets. Let's now try to understand how the currencies, commodities, and global markets are doing. So US dollar is spiked up. It's about to hit the bull zones once again, but it had absolute flattish close on the charts. Absolute flashes. US dollar also is central bank managed, and the close absolute flat at 84 above levels, with the remains weak as usual. Crude oil is fallen down actually compared to last week and sideways hovering. As long as this does not climb up and break out from this channel trend line, then should be okay. There's a Middle East war crisis going on, so it could fluctuate according to the news outcomes that come in there. Gold is at all-time high, but you have an doji, gravestone doji, which is bearish in nature, which indicates some corrections will come in now, but absolute bullish all-time high levels of gold when the market is correcting. So gold is a hedge instrument. Spiking is good for investors who have hedged, but gold is spiking up means equity market. Money may be getting shifted elsewhere. Is the concern. Given the global markets, the same like Dow Jones, Nasdaq, and S&P 500, we see that there is a red that is formed ahead of the US election outcomes few days from now, November 5th. Dow Jones is in correction mode, S&P 500, Nasdaq are in correction mode, and look at how they are. It's flattish down on Dow Jones, 1.6% down on Nasdaq, S&P 500, 1.37%. But momentum is absolutely bullish and taking support out of sight. So it's bullish momentum and bullish with falling momentum is what you see there. So yeah, US market is another market. So if the correction is extending, then it's something to watch out for, because it's another market. But it's not very far from the all-time highs. So yeah, it can turn volatile depending on the election outcome. So keep close watch on this in the coming weeks. Now, 2 actions for the next week. One is on the short side, one is on the long side. And short is Tata Consumer Products. It has a breakdown of consolidation. Momentum has dipped to the bear zones on the weekly, and trend is also in the bear zones. And the good risk reward of 1 is to 1.5 can be achieved on the short side. On the long side, you have the lover's lap. It seems to bring out of that trend lap parallel channel. Momentum has climbed back once again to the zones with volumes, and trend also is closed over to the zones, and decent 1 is to risk reward can be possible. That's the 2 stock picks these are not recommendations, but yeah, for the education purpose, you can refer to the charts and take your own decisions as to trade or invest or whatever, right? And it's enough in the strategy for the next week, because some of the options of Nifty for the weekly expiry of 7th November. It's a bear call spread where we are selling a near ATM 24,450 call and buying a hedge at 24,900 for OTM as hedge. And this number is RiskReward. Exit. So any downside, you're safe. You don't have to do anything. Just book the profit, and if it is exceeding this 24,555, you may have to exit or do the adjustments of rolling up. So yeah, probably is not that great, but 70% nearby, and that's the best thing you can do when market is slightly bearish, right? Cover the side of bearish and then bet the maximum level where it can move up, right? It's a lot of resistance in that zone. That's why it's less likely to move above the 24,500 for the next week. What I guess I may go wrong, yeah, but that is the bet that you can look at, right? It's a bear call spread for weekly expiry on the Nifty for the next week. FNO. Let's just wrap it up. The market has paused up for a steep correction of nearly 8.5% that spread over 4 weeks, and Banknifty also has done that, and then both of them managed to close green, but the momentum seems to be bearish in the case of Nifty, and trend is also absolutely bearish in the case of both time frames and both indices. So if I encourage you to sell, and the correction maximum that has happened, this 72% of rally from June 2022 is only 11%. Small corrections and big bull moves. So yeah, you could expect steeper corrections anytime. Or it could find the support similar to how it gets corrected last time and then continue like. There's an eventful week that's coming on first week, so fingers crossed as to what happens. There's no way to predict such major events like elections. Let's try to put in some factors, parameters in buckets, and then see what's in favor of the bulls and the bears. So the bulls, the Banknifty is stronger with respect to the momentum. Bulls, the bands also, it's absolute consolidation or bearishness. That's the only thing that's in favor. And inside bar and weekly on both indicates that it's probably not bearishness, it's consolidation more likely. So that is also slightly in favor of the bulls, you can say, but the domestic institutions keep buying in, and no matter what the FIs are selling is what is holding the market, and that's what it continues. So most of the things are in favor of the bears. So what are the bearish momentum on the Nifty short term, bearish momentum, bearish trend on both the indices on both time frames, bearish build up on the futures up interest for the Banknifty, bearish put call ratio on both Nifty and the Banknifty, FIs heavy selling 1 lakh crores in October in the long, bullish bands showing downside expansion, bearish bias is what bullish bands is showing Nifty. So Nifty is below the 50-100 and all the expansion areas. India is rising up to 16. Time for caution. Major sectoral indices, the IT, auto, FMCG, they are all in bear zones. Heavyweights, Reliance, deeply in medium term also it's in bear zones. And TC is also bear zones. Kodak Bank, bear zones, short term. So the market is also showing some corrections. Up 10% of corrections happened, and it will hold those levels or further extend or not. The US indices are showing them red. So keep all these things in mind. They're all in favor of the bears. So there is a Middle East crisis, what's going on, Israel crisis, the US election, and all this could create volatility in the market. So install tight stop loss and refrain from taking long positions if you're not sure. Yeah. So when you will be sure, we'll have to get some confirmation that the bottom is found with respect to the candles from the weekly time frame. Either the higher low highs, or pattern wise or moving average wise or momentum wise. You should see some bullish confirmation on weekly charts before you can say, look at this reversing. So that indication was not coming yet. Keep that in mind. So my view for the next week remains, as per what chart is indicating, mild bearish. It was moderate bearish last time, but this time it's mild bearish because there is a possibility the market can find a support here as well. Now always keep in mind that the technical charts, of course, for us when there is a major global events like the war, pandemics, and big events like the elections and all that. Screw up technical analysis is very much known, so keep that in mind when you are playing a trading game and during the event. So either stay out if you're sure, or play it safe with tight stop losses. So 23,000 and 25,000 is the level for the next week on Nifty, and 49,500 and 53,000 for the Banknifty for the next week is the levels that I look forward. But 26,000 and 54,000 on the Banknifty levels, that will decide if the continuation of the rally is going to happen or not, until it's consolidating. So always hedge your positions. That's the best thing. We can look out for the level as well as position levels. Right? Also, we can make some rental incomes whenever the market is correcting. Several strategies that are discussed. Check out the playlist. That's what I have. In brief, market is facing, it's consolidating, it's having bearish bias, it's just ahead of a major event outcome. So play it safe. That's all I have. So if you like the content, subscribe and like and share content and put in your comments and feedbacks and all that. I'm also active in the other channels like Twitter and all that. So check out that as well. That's all I have. Thanks for watching. Happy trading, happy learning, happy investing. Bye.